This is going to be another fun one. If last week was the most important around the horn presentation we've done, this one will certainly be up there as well. So this week's key macro question is, in my opinion, how dangerous is the Trump administration's attack on the Fed's independence? My answers are very, very dangerous. The U.S. may be in the early innings of a balance of payments crisis, and President Trump's attacks on the Fed Chair Jay Powell risks exacerbating the geopolitically driven supply-demand imbalance in the Treasury bond market. Reminder, the U.S. has a net international investment deficit worth $24 trillion, more than two-thirds our GDP. Worse, we have twin fiscal and current account deficits totaling minus 11% of GDP, demonstrating unprecedented degrees of largesse by the U.S. private and public sector. The rest of the world was fine giving us cash in exchange for IOUs to live high on the hog because of our economic exceptionalism. But it cannot be overstated that U.S. exceptionalism was primarily a function of that largesse. If you have a twin fiscal and current account deficits totaling 11% of GDP, of course you're going to grow faster than everybody else. Duh. Duh. Not everybody else can pull that off. But anyway, so moreover, the U.S.'s exorbitant privilege allowed us to finance that largesse at a cost of equity and debt capital that simply does not make sense when compared to peer economies that share our precondition of bloated twin deficits and a debt to liquidity ratio north of 100%. Exorbitant privilege is earned, not allocated, and can be eroded by policy blunders like President Trump, the Trump administration's Fisher-Price tariff formula, and or it can be eroded by a disregard for the rule of law that makes U.S. assets exceptional to begin with, such as nullifying court rulings, however politicized they may be. Just because you don't like it doesn't mean you can nullify it, because you're sending a signal that the rule of law is being eroded to international capital allocators. President Trump, if you're listening. Jay Powell knows this and is doing what he must to preserve our absurdly low cost of capital by doing what every central bank would do to stem capital outflows during a crisis of confidence: implement hawkish policy. The fact that bonds rallied during Powell's incredibly hawkish speech is confirmation of our view. These are the economies that are going to go to that negotiation in the White House and put their feet on the table. Because I would. I'm going to say, have you lost your mind? Do you not forget that we own X% of your bond market? You know, have you, and not just own X% of your bond market, because obviously the threat of selling is one dynamic that we saw on April 9th and again on April 11th. But another dynamic is they could just stop giving us more money, right? And force austerity by forcing a closure of our current account deficit. So we have to be careful. The folks on the other side of the table have a lot of negotiating leverage. In my opinion, I think the capital account is sacrosanct over the current account. President Trump's focus very focused on the current account, specifically trade deficits. But in my opinion, I think when that Japanese delegation showed up and you saw how quick he was to celebrate the progress on the talks, I think the Japanese trade minister went in there and put his feet on the table and said, "Have you lost your mind?" And so I think he probably told President Trump a lot of what we're talking about right now in these charts. U.S. financial assets are egregiously overvalued for any scenario that features a persistent erosion of exorbitant privilege. Let me say that again. U.S. financial assets are egregiously overvalued for any scenario that features a persistent erosion of exorbitant privilege. So right now, if you look at so in this chart, we show the 10-year nominal yield plus the earnings yield for the respective MSCI, equity index, just so we can normalize it. So it's essentially the cost, the aggregated cost of equity and debt capital in the economy. It's approximate. It's not total. It's obviously it's credit, consumer credit, and corporate credit, but it's an approximate cost of equity and debt capital across economies, so that we can compare, who's able to finance its growth cheaper and more expensive than everyone else. And right now, the U.S. is basically tied with Japan, down at 8.68%. Combined, 10-year nominal treasury yield plus the MSCI U.S. index earnings yield. We're a twin deficit economy, right? We're the borrower economy. The other twin deficit economies, if you look at India, it's 10.38%, so essentially 200 basis points higher than ours. If you look at the twin deficit UK economy, it's 12.74%, so essentially 400 basis points higher than ours. And then you look at Brazil, it's about 23.67%. So you're talking about what, 14 to 16 basis points. That's a lot. 1,600 basis points higher than us. I mean, this is This is we could go from here to somewhere over here overnight, just given this chart here. If we really had a serious capital outflow problem that was facilitated by a cascading sequence of policy blunders, that is the risk. I'm not saying it's the highest probability outcome, but that is the risk, though. And so I want investors to be aware that, hey, we're financing our equity and debt capital, like we're a twin surplus, creditor economy, but we're not. So that investors need to be aware of that. And that's what I mean. In this chart, we show the sovereign fiscal balance to GDP ratio for those economies in the top panel. We show the current account balance to GDP ratio in the middle panel, and then the twin surplus and or deficit in this bottom panel. So kind of just isolate the current account. We're minus 4% current account deficit to GDP, worst in the world, at least according to all these major economies. The next closest one is our Brazil and the UK at kind of 3%. India's minus 0.1%. And then you got Eurozone at 3%, China at 2%, Japan at 5%, Switzerland at 5-6%. We're financing ourselves like we're the ones giving everybody money. Like the cost of our equity and debt capital is such like we're the ones with all the money, but we're not the ones with all the money. We're the ones receiving the money. And so that tells you that there's a potential asset valuation mismatch if those capital flows reverse. And that's kind of one of the key takeaways from this presentation is that, if we go from a regime where everyone's comfortable, having a significant chunk of their assets parked in US dollars and US equities and US stocks and US bonds and US, real estate and US private credit, US private equity, that stuff's not all going to go to zero overnight. Obviously, a lot of the fundamental stories behind why you do that are still intact. But all it takes is a change of opinion and perception at the margins, right? The biggest market moving events are when the whole world thinks something is true and it stops being true. And that stuff comes around every once in, probably 10, 20 years. These are the kinds of things that happen, like Lehman going bankrupt. And, everyone, remember when everyone thought that the nation couldn't have a broad-based decline in home prices? And so we levered up our entire mortgage-backed security sector and threw a bunch of leverage into financial products on top of that. And because we all thought there was no way you could possibly see a nationwide default because prices can't go down nationwide. Remember, everybody thought that, by the way. People thought that. Everyone thought that. Otherwise, we wouldn't have got there. Well, my point is everyone can think a lot of things until it changes, and so that's the risk I'm trying to highlight. So again, we're twin deficit at minus 11%. We're on par with Brazil at minus 11%. The next closest economy is the UK at minus 8%. India minus 6% in terms of its twin deficit. Again, we're on par with Brazil in terms of the aggregated sum of our sovereign fiscal balance to GDP ratio of minus 7%. And current account deficit to GDP ratio of minus 4%. We're on par with Brazil. Brazil pays 24% to get equity and debt capital. 24%, or the combined 24% rather, sorry. Combined 24%. We are paying a combined 8.68%. And again, we have the same dynamics from a twin deficit perspective. And so to me, I think we have to be honest about U.S. exceptionalism. This is a public service announcement. We have to be honest about why were we exceptional? Were we exceptional because we have a sovereign fiscal balance that is almost world beating at minus 7%, which is a record non-war, non-recession type number? Are we exceptional because we are investing way more than we save, which is why our current account deficit is 4%? Are we exceptional because we have a minus 11% twin deficit ratio or a twin deficit to GDP ratio, yet we're financing ourselves like we're the ones giving everyone the money, as opposed to ones receiving the money, like Brazil and the UK and India? I surmise that this might have been a contributing factor to why we were exceptional. And so the world can take the exceptionalism away from us. And we need to be very cognizant of that. Contrary to the Trump administration's narrative, the problem is not surplus demand for the US dollar due to its reserve currency status. It's the US's abuse of exorbitant privilege, right? The world doesn't tell us to overconsume or overinvest or overspend government-wise or overtax. It's just happy to give us the money because it keeps them gainfully employed and they can build factories and hire employed workers and keeps them employed too. So everyone's winning in that scenario. But we can't sit here and say like, oh my God, because the dollar is the reserve currency, it's forcing us to have a twin deficit of minus 11% to GDP. No, this is a function of our inability to not live high on the hog here as US consumers, as US businesses, and a US government. We are addicted to largesse. That is the American way. What does the rest of the world think about us when you leave, when you go travel abroad? They think we're all a bunch of fat, over-consuming people. And unfortunately, that's true for a lot of Americans and who can't get off the dole from a government standpoint, who don't want to work as hard as the rest of the world, who don't want to, save as much as the rest of the world. So I think we need to be more cognizant about what's the order of operations here. I think Stephen Miranda is a brilliant man and obviously gets a lot of stuff right. But if he's of the view that the U.S. dollar is its reserve currency status is the reason we have, a 7% deficit to GDP ratio and an inability to cut Medicaid and Medicare and Social Security. Like, that's not the reason. The reason is because we are living high on the hog and we've gotten addicted to fiscal and monetary largesse. We've gotten addicted to not saving. We've gotten addicted to overinvesting. We've gotten addicted to overconsuming. That's the issue. The underlying issue is our abuse of exorbitant privilege, not the reserve currency status. We're abusing reserve currency status. The U.S. federal government is on track to spend 1.1 to 1.2 trillion on net interest this year. Can the U.S. afford a Fed chair that is not attuned to the risk of a reflexive cycle of capital outflows and higher bond yields? We're spending net interest is $991 billion. We know we got another $100-ish billion coming as a function of the refinancing that we need to do from the lower interest rate regime to the higher interest rate regime that we're currently in. So you're talking about somewhere between 1.1 and 1.2 trillion dollars of just interest alone. Can we really afford to have like our bond yields run away from us? And they will run away from us if the world is concerned about central bank independence. If the world, you saw the bond market rallied when Powell was being hawkish. That is a telltale sign that the concern is around the currency in the bond market. And so in my opinion, this is the kind of stuff you only see in emerging market balance payments crisis. I guess I've lived long enough to see, elements of that here in the US. And so we got to be very careful about, our perception of around exorbitant privilege and US exceptionalism and what's driving what and what the ultimate problem, the ultimate ill is and the ultimate problem is. There's people in and around the administration that think it's the dollar's reserve currency status. In my opinion, based on the analysis that we just presented here today, I think it's pretty clearly a function of our, living high on the hog and our addiction to largesse from a lifestyle perspective here in the US that the rest of the world was happy to finance because it gave them jobs. But if we, you could have a very severe mutually assured destruction dynamic occur if we try to bully our way into a different paradigm.